Hello friends, in this video we will discuss cash flow statement. This statement shows to us all the inflows and outflows of cash during a specific financial period. So for example, at the beginning of the period we had $100 of cash, and at the end of the period we had $120. And this statement shows to us all the inflows and outflows to explain how we got to $120 of cash on our balance sheet. So what are those cash flows? Well, of course, these are sales of our products and services. And on the other side, this is cash spent for purchases of raw materials, to pay our employees, and to pay for all the other operating expenses. We can also have inflows from creditors. These are loans from a bank. And again, on the other side, these are repayments of the principal of the loan amount and of interest expenses. And we can have inflows from capital. So our shareholders may decide to do an equity injection to expand our business operations. And on the other side, we again repay to our shareholders in the form of dividends. We can also have cash inflows from asset disposals. We can sell part of our business, or we can sell our assets. And again, on the other side, we can incur capital expenditures to expand our business operations, maybe build another plant, build another office, or purchase another vehicle, or purchase equipment. So we have inflows, outflows, and we can understand how the business generates cash and how they are spending it. Now, if we dive deeper, cash flow statement is separated into three main categories. And the first is operating cash flows, which shows us inflows and outflows of cash from main business operations. So for example, these are cash we receive from our customers for products and services, and cash we spent on raw materials, or to pay our employees, or to pay for any other operating expenses. As you can see here on the table, operating cash flows increased our beginning cash balance, because on average we would expect that we paid cash for raw materials and for our employees, and then sold the products with the margin. So our inflows exceeded our outflows of cash. But it's perfectly normal for operating cash flow to be negative. And in this case, we would maybe purchase raw materials at a very high price and then had to sell our products at a low price. So we had a loss-making operations, and as a result, negative operating cash flows. Or maybe our business is growing too rapidly. So we spent a lot of money on raw materials, but we didn't sell a lot of products. So we spent a lot of money, but we didn't get a lot of money. So we had a negative operating cash flow. But here on average, we would expect that our operating cash flow would hopefully be positive. Then we have investing cash flows. And investing cash flows show us cash inflows and outflows from investments in securities and from disposal or purchase of new assets. So here again you can see that investing cash flow decreased our cash balance, because again, what would we expect? We have operating cash flow from our business operations, and then we spent part of this cash flow on new assets to expand our business. But again, investing cash flow can be positive. So what I mean, we could have sold a lot of our investments and generated positive cash, or we could have sold a large part of our business and again generated a very large positive investing cash flow. And the third category is financing cash flows. And these cash flows show us inflows and outflows of cash to fund the company. So what is it? It's new debt from the banks, or this is equity from our shareholders. And on the other hand, again, this is repayment of this debt and repayment of dividends to our shareholders. Again, as you can see, we show that financing cash flow decreased our cash balance, because let's look at this table. We generated positive operating cash flow from our business operations. Then we spent part of this cash flow on new assets to expand the business, and then shared the remaining cash flow with our shareholders, or maybe we repaid our debt. But again, financing cash flow can be positive. So for example, we received a very large loan from a bank, or maybe our shareholders made a very large equity injection. But on average it would look like this. So we have beginning cash, then it's increased by positive operating cash flow, then decreased by investing cash flow, and then again decreased by financing cash flow, and we get our ending cash. Let's see how cash flow statement is constructed. There are two main methods to construct cash flow statement, direct and indirect. In more than 90% of cases I see indirect method, so in this video we will cover only indirect method. So we have beginning cash balance and we have ending cash balance, and this statement will show us how we got from beginning to the ending cash balance. We have operating, investing and financing cash flows, and if we add operating, investing and financing cash flow, we get total cash flow. So for operating cash flow we begin with net income and then make necessary adjustments to come up with actual cash we made from our operations. So we add depreciation, because if you remember, depreciation is an accounting expense. So we just assume that our assets are getting older and we need to account for this expense. But in reality, we didn't actually pay any money. So we need to add back depreciation to our net income. Then we add back interest expenses, because we will account for interest expenses in financing cash flow. And we have a change in working capital. So here, for example, in our lemonade stand, we accounted for all the cups of lemonade sold, but in reality, for 20 cups, if you remember, we didn't receive any cash because we sold them on credit to our friends. So for change in working capital, we would have a minus cash flow. We would deduct cash flow that we didn't receive from our friends, and we would get operating cash flow. And then in investing cash flow we have purchase or sale of property, plant and equipment. And in financing cash flow we have loans received and loans repaid. We have loan interest paid, and we have equity injection and dividends paid to shareholders. And when we add all this together we get total cash flow, and when we add total cash flow to beginning cash balance we get ending cash balance. This may sound very complicated, but let's get back to our lemonade stand to understand it better. Let's see at day one of our lemonade stand. We get $1,000 from our shareholders and we get $500 from our bank as a loan. And in total we get $1,500 from financing cash flows. Then we have $1,000 from purchases of property, plant and equipment. If you remember, this is $800 for the lemonade stand and $200 for the equipment, the mixer. And in the operating cash flow, if you remember, we have a inventory increase of $100. This is $50 paid for the oranges and lemons and $50 for the cups from our supplier. But we only spent $50 for the lemons and oranges. The $50 for the cups, we didn't actually pay any money because it was purchased from our suppliers on credit. We promised to repay our supplier at a later date. So this is reflected in payables increase of $50. And the net change in working capital is $50. So if we simplify this, we just had $50 and we spent it on oranges and lemons. And we have operating cash flow of negative $50. So when we add operating, investing and financing cash flow, we have a total cash flow of $450. So we had a beginning cash balance of $0 and ending cash balance is $450. Let's make it more complicated and have a look at week 1. So if you remember, in week 1 we had net income of $22. We add back to $22 our depreciation expense of $10. And we add back $2 of interest expenses because we will account for interest payments in financing cash flow. And in change in working capital, this is quite complicated, but we will try to break it down. We have a receivables increase of $60. And what it is, we had 20 cups sold on credit to our friends at $3 per cup. So this is $60. So we subtract $60 because in the profit and loss statement we accounted for all 90 cups and we assume that we sold all of them. But in reality, 20 cups were sold on credit and we didn't actually receive any cash for them. So we need to deduct $60. And then inventories. We have inventory increase of $10. Let's dive deep to understand change in inventory. We had $0 of beginning inventory, then we purchased $100 worth of inventories, and in cost of goods sold, we accounted for $90 worth of raw materials used. So we didn't account for this $10 worth of inventories purchased. So we need to account for it in the cash flow statement. And then we have payables increase of $50, which we owe to our suppliers. And we have a net change in working capital of minus $20. So 22 plus 10 plus 2 is $34, and minus $20 of change in working capital, we have $14 of operating cash flows. Then we have purchases of $1,000 worth of property, plant and equipment. This is $800 of lemonade stand and $200 for the equipment. So we have a total of $1,000 for investing cash flow. Then our equity injection remains unchanged of $1,000. We have $2 of interest paid, and to calculate loans received and repaid, we received $500 of loans, and we had to repay. To calculate repayment, we have 2 years term of the loan and weekly repayments. So if we divide $500 by 2 years, we have annual repayment, and then if we divide annual repayment by 52 weeks, we have a weekly repayment of $5. So we received $500 and repaid $5. We have a net $495. So our financing cash flow is $1,493, and our total cash flow is $507. So we had beginning cash balance of $0, and by the end of week 1 we had $507. Now I will ask you to build a cash flow statement for week 1 of our lemonade stand yourself. Please take a piece of paper and from a blank sheet try to fill out the cash flow statement. You will now see the first hint of how the cash flow statement is structured, and then another hint will show you the answers. In the next video we will discuss how financial statements interact with each other, and I think it will be interesting. Thanks.